welcome to the Private Equity Exchange Roundtable on tech buyouts, buying and building tomorrow's champions. I'm Jeff Koza. I'm the editor for Iberia for Leaders League. Today we're going to have about 40 minutes for the roundtable itself. Then we'll try to leave about 10 minutes at the end for Q&A. Today we are extremely fortunate to have an excellent set of panelists. I'm going to ask them to introduce themselves one by one, starting with my left.
Hello all, happy to be there with my mask today. I'm Raphaël Compagnon, heading Tech of Digital for Edmond Rothschild Corporate Finance.
Hi, I'm Philippe Crochet. I'm one of the managing partners at Kinsight Capital. And Kinsight is a private equity fund focusing on growth buyout deals in the tech and healthcare sectors.
Hi everyone, I'm Alex Margolin. I'm the head of the Paris office at Tommorow, of which I'm a partner of. And Tommorow is a private equity firm with global presence.
Hello, I'm David Malamed. I'm a partner at Moncel Law Firm, and very happy to be here and see all of you.
Gabriel Pacheco, I'm a co-founder and CEO of Safety. Safety is a digital platform for real estate agents with internet-only presence and no physical agencies.
Hello, I'm Antoine de la Gatinet. I'm a partner in the M&A department of Gide, the law firm, focusing on private equity and M&A.
Excellent. And before we get started, I really have to apologize. I am certain I am absolutely going to murder the pronunciation of all of your names because I don't speak any French. So before I slaughter your names, I apologize humbly. But let's get things started with Alex. So what sort of features do you look for in an investment opportunity?
So, any investment opportunity, or
well, tech buyouts.
Actually,
yeah.
So, yeah, and look, this was really the point. I think tech buyouts now have a lot of similarities with any other type of buyout. First and foremost, what we focus on is the product, actually, of the business. We think this is really the core of a tech company. And this is where we focus a lot of our due diligence, a lot of our attention. And what I mean by the product is its scalability, the quality of its structure, architecture. This is a very fundamental point for us. The second one is, of course, as usual, the management team. And again, within the management team, the fact that we really enjoy and appreciate the fact when a CEO is a product-centric CEO with a deep vision on the product, on the platform. And if we actually take the example of Safety, where we're delighted and honored to be the partner of Gabriel in this adventure. Gabriel and his teams are very focused on it. We have plenty of other examples in our portfolio where it's exactly the same. It really starts from there. The third point is what we internally call the swim lanes. So because very typically in tech, you always have the elephant in the room is Google going to do this, or is Amazon going to do this, or is Facebook gonna kill you, or so making sure that you are well aware of what the specific swim lane of the business you invest in is clear, and where you feel good that these big players will not come and compete against you, and if they do, that they don't have a very significant differentiation. That requires actually a lot of early investment to understand their strategy, their roadmap, and where they want to go. And again, I mean, we've had several examples of this where we've had to do a lot of research, spend a lot of time with these big tech companies to ensure that whatever is on their roadmap is not to kill the company that we're about to invest in. And finally, but that's really obvious is growth. So we're a very growth-oriented fund, and also in tech, we want to make sure that growth is there, that there is a large runway, and that that growth is also a resilient one with a recurring business model or reoccurring business model.
So growth, management team, and make sure you've got a clear lane that's not going to be blocked by Bezos or Google.
Yeah, and especially thanks to a highly differentiated product.
Mm-hmm. Gotcha. Philippe, do you want to?
No, maybe just a quick comment, because I think from a lot of aspects we have a similar strategy as Permira, and I would agree with most of the parameters that Alexandre has put forward. Just one quick comment on the competition from like the big tech champions like Google or whatever. I mean, most of the time people assume that if you invest in tech, you will at one point end up against one of these guys. But as a matter of fact, at least within Kinsight, we really try to identify niche where we can find companies that will be international leaders, and niche that are actually quite protected from these big champions, because that's not really what they focus on, right? So you can identify in very specific niche where you can find mid-sized international leaders and where you will never face any competition from one of these tech champions.
Yeah, and on that point, maybe it was like very strong like a few years ago, but now like the regulatory environment changed a lot, and now you have like entry to barrier concerning tax and as well data protection in Europe, and for tech champions, the GAFA, it's like more and more difficult to enter this market. And now you have like all this sovereignty play to play for the tech players in Europe and in France as well.
So some of the new regulations and protections are maybe giving a little bit more breathing space or opening up those swim lanes, as it were, at least from buyouts from the US. What about competition from big European players? Is that also a concern, or not as much?
I'll try and answer to that question. Look, it's still actually difficult for me to see how regulation has a real impact on these big tech giants. I hope that we'll see this change in the coming years. But for now, our strategy has been to be like fundamentally, as Philippe was saying, like are we in a clear niche that is protected from these guys? Or, as a matter of fact, sometimes we're even investing in businesses that are enabling its clients to fight against these big tech companies. And in a way, Miracle, which is one of our invested companies, is enabling a lot of its clients to compete humbly, but compete with Amazon. And there are many other examples like this. I'm a bit of a skeptic on regulation, at least for now.
Any follow-up to that? No? Gabriel, then let me throw it to you then. As a portfolio company, what is your growth strategy, and how does your specific technology play into that?
Yeah, we have a strong growth strategy since the creation of the company 11 years ago. Today we have something like 220 million euro revenues this year, with 40% growth. That's an hyper growth, and with 7,000 agents in France, and the presence in four countries, nearly 4 countries in Europe. So we have a very strong growth strategy and organic strategy. And this strategy is based on the disruptive business model, really, of the company, with no brick and mortar agencies and internet presence only. And this is based on the technology, really. We have a platform, 100% web-based platform that allow us really to manage all the activity of the agent. And we have something like 50 engineers developing this platform. And it's up to us to have to create a competitive advantage.
So by not having that brick and mortar framework, by being focused strictly online, that's really a growth advantage for you then, that sort of technological advantage.
Yeah, and that's a technical advantage. And of course, the growth strategy is based on the recruitment of agents. And really, we have a very attractive business model for them, and that allows us to recruit a lot and to give them the best tools, marketing tools, trainings of all kinds, and of course, this software.
Let me open that up to some of the other panelists. More generally, how much does a portfolio company's technology play into their growth strategy, or the growth strategy as you see it from your strategy as the owner?
Maybe I can start. I mean, within our positioning, as we focus purely on tech and healthcare investments, and as we are looking for growth, I guess like our colleagues from Permira, of course, technology is playing a key role in enabling this growth. But of course, it's necessary, but it's not sufficient. And there are a lot of other ingredients you need to find in a company, as Alexandre was mentioning. And of course, well, the first one is management, in order to make, to leverage this technology to make it a success.
So again, technology necessary, but not sufficient. They've got to have good technology. It's got to be something that allows them to grow, but that can't be the only thing that you look at. Yeah. Anyway, please.
Yeah, look, maybe just one thing to say is that the conundrum often on tech buyouts or tech acquisitions is that in some cases these companies are not profitable. And so you have to figure out whether or not this is investable. And we often look at what we call unit economics. So making sure that whatever R&D dollar that you put into the product, or R&D or marketing or sales that you put in the organization, has a sufficient return. And in spite of, in some cases, in spite of a great product, all these dollars actually are not worth the while, because unfortunately the unit economics don't work. And so that's also a clear arbitrage that we need to do. So once we have clarity on the quality of the product and the quality of the technology, it's making sure that any further dollar invested in R&D, sales, or marketing is actually generating outsized sales, and therefore providing visibility on profitability within the next 12, 24 months. That's a difficult equation to solve.
Yeah, and maybe in general, talking about products, like it's a very important topic, because it's about net dollar expansion for the company. So how many dollars you're gonna gain from your existing customer, and we're talking to that. If you have a strong product, it means cross-sell. At some point, it means churn. And when talking to churn, it has a strong impact on revenues, because there's, for example, a study from Harvard Business Review saying that just a 5% reduction in churn rate can increase profit from 25 to 95%. So sometimes it's better to focus on existing clients with a strong product, better than going on acquisition first.
Sorry, let me get you to repeat that. So that's a 5% churn on the client side.
Reduction.
A 5% reduction.
Churn rate.
Leads to, what was the percentage on the...
Like a strong increase in revenue, because then you can just leverage on your revenue base better than focusing on acquisition.
Understood. So, sticking with you, Raphael, traditionally investors have been focused on EBITDA as the primary metric. Is that still the case with tech buyouts, or is the focus now shifting to recurring revenue or some other metric?
EBITDA still remains like the primary metric, because at some point you need still to leverage the deal, but now like ARR, so annual recurring revenue, is gaining more and more importance, because ARR means this is an indicator of like the reliability of revenues, predictability. If you have predictability for lenders, they are more keen to lend. And now you have like the PE world, traditionally based on EBITDA, shifting toward this metric, and even like some lenders more open to lend on ARR basis in the first stage.
Mm-hmm. So how sticky those revenues are year to year?
Exactly. Yeah. And you have ARR, but it's always in parallel with churn, because if you have recurring revenue but losing all your clients, it does not mean anything. So
I think it's a very important point that Raphael is making. It's true that at Kinsight at least, we are still focusing on EBITDA. I mean, at the end of the day, the company has to generate cash. And it's true that we see more and more investors or even lenders focusing more on ARR. But as Raphael was mentioning, I mean, even if you focus on this metric, you have to demonstrate your ability on the long term to generate cash, because you can still invest a lot in growth, generate a lot of ARR, and have a model that doesn't fly. So well, at least on our side, we still focus strongly on the EBITDA metric.
Yeah, and if you focus on ARR, you have to be more picky in analyzing the company, because you have to put in parallel ARR relating to the acquisition cost, like the acquisition strategy of your customers. It means that in general, then you derive lifetime value over CAC, and you analyze really the revenue strategy of the company.
Alexander, did you want to weigh in on that, or?
No, I mean, Philippe and I have discussed actually this very point not that long ago, and I think it's a slight difference between Permira and Kinsight, where we do lean in and are, as long as we're able to prove that the unit economics work, we're ready to value businesses on an ARR basis. Mm-hmm. But we clearly look over the long term at the what would be the profitability and the cash flow of the business. And we do see a number of businesses where, you know, lots of great investors are investing in, but we're not ready at this stage, because in our mind the equation is not proven. Mm-hmm. You know, you've got as many points of views than investors anyway in the private equity world. So there are various shades of grays in the philosophy of investing. But it's it's fair to say that the recurrence of the software business models do allow us to take a view on a revenue basis. And maybe just a practical example is, you can totally see a business that's growing at, say 10-20%, very profitable. Even actually Safety is growing at 40%, it is super profitable. But then you wonder, okay, the market is huge. Isn't it the opportunity to go land grab and invest way more now in sales and marketing, for example? It could be R&D, but let's say way more in sales and marketing there. Then the business will become not profitable for a while. But you would only do this because you feel good that, when it returns to a 20% sort of growth, then it will re-become profitable again. And that's a question that we're asking ourselves on many of our portfolio companies, that in some cases are profitable, we're turning them into non-profitable and to generate a much faster growth, so 50-60%, to then return to a more a lower growth.
So that question of, do you take that hit in the short term
Yes.
on the investments, even though it's going to impact profitability in the short term, with the hope that investment is paid off within sort of your investment time horizon, and to get back to that 50-60% growth?
Yeah, exactly. I mean, that's a question that often we ask ourselves in the first 12 months of our investments.
I feel a little bad because I have trouble seeing the gentleman on the other half of the stage, but I want you to give the opportunity to weigh in if you.
From a pure legal standpoint, I think we see the evolution between EBITDA and ARR. I would say, because we represent very frequently lenders of ours, in my view, lenders are still very much focused on the EBITDA as opposed to ARR. They want to see some kind of profitability, and when we have to calculate all the ratios and put that in the documentation. It's still pretty much focused on EBITDA. So there may be a switch for tech companies, but in the long run, what we've seen is that tech companies have generally have a tendency to normalize the other businesses. I think where you have a very, very big difference is in the multiples and the price that this company can fetch, really. But in terms of economic metrics and the way we would actually translate it into a legal documentation, it's still pretty much the usual metrics that you're used to in our.
Yeah. So among your clients, EBITDA still reigns supreme then?
Yeah, that's pretty much what we see.
And you mentioned seeing companies sort of normalize over time. You mean that?
Well, at some point, as they say, a company has to make money. It's true that Amazon maybe has never done a profit, not true anymore, but eventually, yes, investor will want to see that the company is profitable. You have very, very few companies like Amazon that can spend that much time without turning a profit, but in reality, eventually, if you want to exit into an IPO or anything like that, the company has to be profitable. So, the sky is always the limit, but at some point you have to come back to earth also, and that's what the investor will want.
David, what sort of new legal structures are you seeing in tech buyouts, in particular either SPAs or funds selling portfolio companies to other funds within the same firm? What are you seeing from the legal standpoint?
Yeah, what we've seen, and we have actually a transaction right now that's going to we'll be signing at the end of this month and closing early next year, is this tendency that we've seen in the US, started in the US and now coming to Europe, where funds have a tendency to sell to themselves, have a new investor coming in, so they create a new fund, a friend, generally a large buyout fund will pop in, and that gives the ability for the fund to make sure that they don't lose too much value on this exponential growth that tech companies can have, where the beginning can be a bit slower, then suddenly, it's taking off. So, when you have those parameters where you have to invest in 4 years and then you have to sell within the next 4 years or 5 years, that creates artificial limits for companies that may have a life cycle which is different from a traditional PE investment. And so this is, in my view, very, very deep trend that we're seeing. It's generally for generally large companies, but it's not inconsequential. And the fact that it's coming to Europe is also a sign that we have companies that are sufficiently mature for US funds in particular to implement in Europe those kind of structures. So I'm telling you, we're seeing it in one deal. Alors, the consequences are actually deep in from a pure legal standpoint, because you have SPAs where you sell to yourself. So you have some kind of reps and warranties, but at the same time, you take all the insurances, the warranties, insurance, etc. But at the same time, you know that you're selling to yourself. You know that you're bringing a friend with you, and so you're a bit schizophrenic in a way, because you're selling, but you're also buying, and it creates an ambivalence sometimes that we have to play with. So we'll see what the market will say about this and the evolution of the structures, but it's interesting from a pure legal standpoint.
Antoine, let me ask you the same question. Are you seeing a similar trend?
Yes, I see clearly a similar trend. Just to add on what David just said, that is, I concur completely with what he said. It doesn't. When you sell to yourself, it doesn't mean that you don't need to make all the checks that are necessary when you have an acquisition process, especially in terms of approvals, regulatory approvals that might be necessary for the transaction, meaning antitrust, foreign investments. It's not because you have, let's say, a community of investors that are the same that you are exempted from those questions. It doesn't mean that you will have to file an antitrust, but you need to check the governance of the company post-transaction to make sure that you do not forget those checks that you absolutely need to make anyway.
So just because there's a large overlap in the ownership structure, that doesn't mean you get to avoid due diligence or all the usual.
Exactly. And due diligence, yes, but also regulatory approvals. Especially because those companies, they are usually large and they cover a large number of countries. So you need, and the rules are different in any jurisdiction in this respect. So you may have to file somewhere, even if in most of the places you will be exempted from filing.
Is this an issue with new investors coming in from maybe a different jurisdiction as well? Is that something that triggers like an additional set of regulations potentially?
Could be if the majority investor is coming from a different part of the world. It could be a modification of the governance of the company at the occasion of the transaction as well. Especially if you have two co-investors sharing the power within the company, while in the first place it was only one. That could be clearly triggering the need for filing.
Let me ask the rest of the panel: are these structures or these trends something that you're seeing as well, or looking at?
Yeah, we've set up something that's similar to what you were describing, which is a continuation fund that effectively acquired the remaining assets of one of our past funds that was actually a fund dating back from 2006 that was raised in 2006. But in that fund there was Genesis, which is actually a carve out of Alcatel-Lucent, which is a software call center software business. The business was doing amazingly well. We've never sold it because we just love the business so much that it's difficult to. It's always a very, very hard decision when you really like a business. So the decision we made the acquisition at the time in 2011, and instead of selling it, which of course we could have, we've decided to, as you were saying, sell it to ourselves, because the business continues to grow at more than 15%, and as I said, I mean the dynamics are extremely positive. Not to say that we only sell the businesses that underperform, because but sometimes you just pick one out of a fund, one or two that are just vastly outperforming and where you just don't see the end of it.
That sounds like a good dilemma to have.
Yeah.
I think Sequoia, I think that's the fund, they actually decided to get rid of this investment period and do this perpetual fund, which would be actually a fund of fund investing in all their private equity businesses. So, as you say, it's not for every deal that you're going to see that, but when you have clearly a curve that may be accelerating, it's very hard for a fund to decide to sell, knowing that, yes, they're making a good return, but at they stay another 2 or 3 or 4 years, it would be completely different. So, I think this trend is here to stay, not for every deal, but it's something that we will see more and more in Europe.
Sorry. Philippe, did you want to add to that, or?
No.
Oh, okay. Okay. Is this something that we're seeing more of as a result of the pandemic at all, with investment horizons perhaps having to have lengthened over the last year, or have you not seen that impact at all?
Well, it depends on what market we are speaking about, but within really the tech buyout space, I don't think that the pandemic has made our holding period longer. Maybe sometimes, of course, maybe you have lost like 12 months, in which case, in order to reach your value creation milestone, you might want to wait 12 more months. But on the other hand, the market is extremely active, and we have seen recently, actually, I think the companies within our portfolios rotating faster than before.
Alex, same for you?
Yeah, same. I was going to say, unfortunately, almost the opposite, where we see assets growing so fast that they spin faster. It's not the case of our portfolio. We actually tend to just keep longer the businesses that we like, but that's definitely what we've seen on the market.
On the other hand, then, is that actually speeding up people's exit strategies? Are we seeing funds with portfolio companies that were growing much faster than they expected and now thinking about exiting perhaps 12 months, 6 months prior?
Yeah, no, of course. I mean, exactly as Alexandre was mentioning, I mean, the fact that within this tech space you have companies that grow so fast, they generate very quickly interest from strategics or other PE funds. And if the company has grown so fast that it enables you to reach your value creation milestones quicker, and you get a nice and straight offer on the table, you might be inclined to take it.
Antoine, what are some of the new legal issues that you're seeing in the tech space? I'm thinking either from an IP standpoint or just from the standpoint of making sure that your technology or the technology of the company stays viable in the future.
I will start with the last part of your question, if you agree. IP is clearly protecting innovation. It's designed to do so. And IP rights, they give you a monopoly over time on your inventions, basically. So you are granted, while you use IP, with 20 years of monopoly when you have patents. You have 15 years for databases. You have 70 years for softwares after the death of actually the inventor of the software. So basically, IP gives you a long protection. And I think in this respect, it's worth investing in IP because it will protect your market position today. And clearly, you don't want your competitor to be able to copy your technology. But what IP cannot do, and I think this is the last part of the question, is protecting the evolution of the technological environment. And obviously, what makes a technology viable in the future is the technology itself. It's the ability of the company to organize itself, to continue to produce innovation in order to remain above the competition. And this is not a legal question. I mean, we've heard all our specialist speaker here. Clearly, the question is the product right? Is the company well organized to continue to deliver innovation that will stay ahead of the competition? So IP is for today, but for tomorrow you need to rely on something else. I mean, that's clear. Now, coming to the first part of the question about new legal challenges, I will pick two. The first one is not totally new. It's GDPR. GDPR is not a new subject because in France, at least in Europe, companies should have been compliant with GDPR for 3 years now. But the CNIL, which is the French regulator, as you may know, granted an unofficial 3-year, let's say, grace period, and this period is now over. And there are more and more controls. There are claims by customers, and the sanctions could be very high. Sanctions could, I mean, the sanctions is 20 million euro or 4% of your global turnover, whichever is the higher. That's the maximum sanction. So the stakes might be very high. So you need to, when it comes to looking at a company that is processing a lot of data, especially if they are sensible data, a big part of your due diligence, I think, is to check how compliant is the company in terms of GDPR. Just one example in this respect is a few years ago there was a company called FeedsUp. I don't know if you remember this company. FeedsUp received a warning from the CNIL because it was not compliant because they were following their customers, basically geolocalizing people. And they received that warning, and they lost the confidence of their clients, and they adapted their model to meet the CNIL requirements. But in the meantime, the clients had left, and the company went bankrupt. So clearly, this is not a pure theoretical subject. I mean, there are really businesses where this is a key area of risk that needs to be looked at carefully.
And it's actually going to be more and more. You know that you have two very important directives being discussed at the European Union, the DSA and DMA, which clearly are aiming at the GAFAs. And what Antoine is describing, I think the GDPR was just an appetizer. A very light appetizer compared to what we can expect in Europe. And I was actually listening to Thierry Breton about 2 weeks ago on this subject, and is the lead commissaire on this one. Is very clearly, strongly aiming at the GAFAs. And so we'll see what that will give us in Europe, whether we'll have, as Google claims, a kind of second-tier internet in Europe, or whether that will be a new opening for European companies in that realm of privacy. But it's certainly not a light subject anymore. I don't think you can take that for granted or assume that because you're a big player, you will make your way and force your entryway into the European zone.
Excellent. To wrap up then with a final question before we get to the Q&A, we've talked about the importance that a management team has in a portfolio company. Philippe, how do you convince a management team to work with you, and how do you go about identifying the ones that you want to work with?
Well, within a market where there is quite a lot of money, I mean, I think the way that Kinsight differentiates is by being able to identify segments of the market that we will like, and then by being able to convince the management to work with us. The result being that, just to give you a few figures, that we, in 2/3 of our investments, we are the first investor on board. So we are the first financial partner that the management team accepts to work with. And we also, in 2/3 of the cases, we also do our deals outside of a process organized by an investment banker. And the way we do it, basically, is by having developed a very, I would say, specific methodology to identify the niche that we want to explore. Then we try to meet the management of all the companies that are acting within this space. And then we have to, as you mentioned, convince this management to work with us, especially when they don't have a financial partner and when they don't have any specific reasons to let a financial investor getting in, because these companies are profitable. And I think that's where being very focused on specific sectors is important, because having invested in tech for the last 20 years, I think it's easier for us in front of a management that has never met a financial partner to explain the kind of value we can bring, and to also organize discussions with the CEOs of our past companies in order to demonstrate the kind of value we can bring to this management.
I'm sure that Philippe will like this word. When you invest in tech, you need discipline. And the thing is, because tech means really tech software and tech-enabled services when investing. And then when looking to software, you can split the software sector in 50 verticals. So it means like you have plenty of opportunities when investing in software, and then you can have like specific strategies to address niche. That will be like huge player in the niche, and then with like strategic value for the bigger player.
So the discipline to stay in your niche where you have expertise then?
Yeah, and the fact of being extremely focused on and being perfectly clear on what you're looking for enables you to be much more efficient. First of all, in identifying the companies, but also in winning the deal. And by winning, I mean either convincing the management if you're alone, or being more differentiated than your competitors if you are in auction.
Alex, I see you nodding your head over there.
Yeah, I mean, yeah, it's look, everything that Philippe just said is absolutely right. I think people often underestimate the variety, the diversity that you can find within tech. I mean, we actually, as a firm, we have 4 sectors, and tech is one of them. As a matter of fact, we almost consider now tech as a horizontal, transversal kind of thing where, I mean, we all see it in our lives, right? I mean, tech is everywhere. So within our teams, some people are now very specialized in, sometimes it's going to be, I don't know, marketing tech or education tech or advertising tech, et cetera, et cetera. So that's the only way eventually as an investor you're going to win this game. If you just say, I invest in software, you've almost lost the battle already.
Any final thoughts before we open it up to the Q&A? All right, I think we've still got a few minutes left for questions from the audience. If there's no questions, many thanks for your attention. We are pleased to close the morning sessions of Track 1. It's now time to join the networking lunch in the Longchamp room. After the lunch, Ashim Pawn, Head of Sustainable Investing at Triton Partners, will open the afternoon panels with a keynote speech at 1:45 p.m. at Etoile 2 room. Thanks very much.